Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. When it comes to equity derivatives, few individuals have traded more options than John Succo. Across a career in markets spanning more than 3 decades, John has managed convexity risk on both the sell side and buy side through high and low periods of vol and across single stock and index options. During the course of our discussion, John shares his many rich stories. He brings to life the early days of his career, one in which option pricing inefficiencies were significant across both strike and time. He describes one of the largest early hedging trades he orchestrated in 1989, a collar on the S&P shortly before the UAL mini crash in October. And he has plenty to say about the spectacular blowup of LTCM, an outcome that surprised him very little. A theme throughout our conversation is John's careful attention to sizing positions and his overall objective of remaining long gamma. While the lean periods for volatility make this challenging, John successfully managed decay through active position management, trading the range of volatility and offsetting some of the bleed through long single stock vol by selling index volatility. The result was that his hedge fund, Vicis Capital, became looked upon by institutional allocators as a valuable addition to a portfolio of generally correlated risk assets. The orthogonal nature of the return stream from Vicis was of great value for investors in the period leading into and through the financial crisis. Today, John is a partner at SS Financial and remains a keen and skeptical observer of markets. On his mind mostly is debt, and the view that it is the sudden stop of unsustainable leverage that usually figures complicit in big vol events. Please enjoy this episode of the Alpha Exchange, my conversation with John Succo. My guest today on the Alpha Exchange is John Succo. He's a partner at SS Financial and a gentleman that has seen his share of ups and downs in volatility, traded a few options along the way in his career. John, thanks for joining me on the Alpha Exchange today.
Hey, Dean. Thanks for having me.
As I said, I thought of reaching out to you. It's been a while since we talked, but we're colleagues from Lehman Brothers in the 90s and followed your path into trading a lot of vol at your hedge fund. So I thought we'd have a great conversation just around some of the big risk events that you've traded through, managing convexity risk, running a big customer franchise, and then starting and managing a large multi-strat hedge fund. Why don't you take us all the way back to the beginning and how you got into the derivative space? What is it that got you started?
Well, I started at Indiana University, where I was kind of mathematical, and there were 2 professors there. This is back in 1982. 2 professors, Klumkowski and Simkowitz, who were very interested in the options market. And I had to do a thesis. So I knew Klumkowski. I walked in his office one day. I said, hey, I need to do my thesis. And his eyes lit up. He said, I got just the thing for you. He called Simkowitz in the office. And a month later, I was writing programs to analyze data from the CBOE. Now, at that time, they just had call options. So we did a big empirical analysis of the efficiency of call pricing. It wound up getting published and wound up getting interest from Wall Street. And I remember a guy from Morgan Stanley came and just walked into Klumkowski's office, and Klumkowski gave me a call. Next thing I knew, I was sitting there in the office, and the guy offered me a job, and I said no. I had some other interviews to do, but it turned out I took a job at Morgan Stanley. That led to a 10-year career at Morgan Stanley.
The academic research that you did had an empirical focus. Were you looking for evidence of inefficiencies in terms of how options were priced?
Yeah, I mean, very inefficient, obviously. Back then, you had a handful of market makers on the floor who got extremely rich by taking advantage of those inefficiencies. Guys like Irv Kessler and Mark Kellner, Danny Asher were kind of like the 3 that I remember. They would simply buy this call, sell this call, hedge it with stock, kind of turn it into a riskless trade and take out huge rates of return. So in other words, one strike versus another, one expiration versus another, were not priced efficiently at all. And people coming in to trade them really didn't know any better. So the market makers, the spreads were wide. They used the right amount of leverage to take out huge spreads at basically riskless kinds of levels. In fact, when I was at Morgan Stanley, I got to know these guys because my first job at Morgan Stanley was on the options desk. And I was actually a salesman. I was in Chicago. I moved to Chicago. I called these guys up and we wound up making markets with them. So a customer would come in, want to buy, a couple thousand calls or a couple thousand puts. Morgan Stanley would take some of it and we would call these market makers on the floor to see if they wanted to take a piece of it. So they provided liquidity to us. It was a great business. We built our business at Morgan Stanley into probably the predominant options desk on the street. So whenever people wanted to do a trade, they would come to Morgan Stanley. So the one thing, though, that didn't trade very much were index options. Now, there was the OEX, which are 100 stocks. So people could stand in the pit and take, like, say, the top 20 names in the OEX and use that to hedge the OEX. So it was the easiest index option to trade of a broad index. The one thing that wasn't trading, interestingly, was the SPX. 500 stocks, which was much more difficult to trade. I remember looking at the pit. There was no one standing there. And one day I said to myself, this would be a great product for institutional traders and money managers. So I kind of put a business plan together, presented it to Morgan Stanley, said, hey, we can make markets in the SPX with the new electronic trading and executing 500 stocks at once or a good portion of 500 stocks at once. So let's make a new product. I think it would be of high interest to institutional money managers because the S&P 500 was much more relevant to what they did. So they accepted the business plan. I moved back to New York. We started to try to build that product. It's a long story, but it's kind of important to my career. So I remember one day, it was late summer of '89, and it was right before United Airlines. A lot of M&A activity during that time. United Airlines was going to get taken over. Anyway, so I walked into the one morning meeting to the salesman. I said, look, the S&P is up 12% for the year. You can sell this out of the money call and buy this basically at the money put against your S&P 500 portfolio, and you can get another 3-4% on the upside and completely insulate the downside. Everybody kind of looked at it. I walked out of the meeting. The head of the sales desk, Shell Johnson, comes up to me. He goes, hey, if I show this to somebody, you sure you can do this trade? And I said, yes, we can do this trade. So he comes over about 2 hours later, and a big pension fund said, I want to do $1 billion of this trade. Back then, $1 billion notional was a big deal. I remember just saying, you're up on half, go sit down, I'll be back. So I nervously got on the phone. I called Danny Asher, all these guys, all these big market makers. And I basically said, I want you to walk over to the S&P pit. I'm going to do a trade. They walk over to the S&P pit. We put up the trade. They took some of it. I took some of it. And by the end of the day, we were up on $1 billion of the trade. And by the end of the week, that crowd was 50 people. And that was the very first collar trade. Okay, that became a huge business on Wall Street. And of course, a couple months later, the United Airlines debacle happened. The market had a mini crash, and that hedging strategy then became very popular.
I was going to just ask you to think about or describe the pricing of that because it's 2 years post the crash. My understanding is that the vol surface kind of went through some permanent change as a result of the experience of the crash. Things were a lot flatter going into October 87 and came out with a reasonably persistent skew. When you thought about pricing that collar, it's a while ago now, but how did you confront the vol surface in the S&P?
And that's why the market makers took the other side of the trade, and that's why I took the other side of the trade. Even though it was a good trade for the customer, in volatility terms, it was a good trade also for the market makers. So the market makers are looking to take out a spread, and they'll lever that spread. And they'll lever the spread based on how much risk is in the spread. So, for example, if they're selling a call and buying a put at the same strike, they'll use a lot of leverage. But if they sell an out-of-the-money call and buy an out-of-the-money put, that's got risk to it. And what a market maker is constantly trying to do is they'll buy that out-of-the-money put, sell that out-of-the-money call, and do spreads to try to make those strikes pari passu and take out all the risk on the trade. So the more they can trade bid to offer, and the more they can get a little bit of an edge on an initial trade, the more money they can make. So there was skew. In other words, the out-of-the-money call was trading at a cheaper implied volatility or relative price to that out-of-the-money put. And so in volatility terms, they were taking on an edge and putting on the trade. Now, back then, at the very first trade, that spread was pretty good. Now, the more people do that trade, so the more people say, oh, I want to do a call or two. So they come in and they'll sell a call, buy that put, and the skew will widen and widen and widen. So at some point, the relative trade doesn't become so good for the customer, it becomes better and better for the market maker. So that demand, that supply and demand begins to level off, so it won't continue. It winds up just like all supply and demand markets, arriving at some kind of equilibrium where it does still benefit the customer to do the trade, and it benefits the market makers. And then they started doing those collar trades for tax purposes. So if somebody owned a lot of stock, for example, and they didn't want to sell the stock for tax reasons, they could put on a long-term collar, selling a long-term call, buying a long-term put, basically kind of take out most of the risk, but they wouldn't have to pay taxes on that trade until everything was exercised. And so those types of trades became used, and Morgan Stanley did a ton of those trades. And that what usually happens is derivatives are a very flexible instrument. So the research guys and the analytical guys are always trying to figure out tax angles and different ways to use those type of trades.
One point you make in describing this S&P collar is the notion that a trade that goes up may have some copycat effect. Maybe more people want to do the same thing. And so as, again, supply demand, that new equilibrium is found, it might put the original writer of the downside, let's just say the seller of the downside put, in a situation where, because more and more folks have done it, the vol to the downside has gotten marked up and up and up. It's a more attractive sale in some ways for the original liquidity provider, but the mark can be painful. And I'm just curious in terms of, and we'll have a lot to go through in terms of how you ran the sell side book, but just contemplating that notion that, okay, I like this level, but a lot of other customers might come in and do the same trade, and I've got to think about a situation in which the mark is progressively against me. Is that a big part of the calculus for you?
Well, that's why some market makers and some traders survive and others don't. But just like in investing, if you take too much risk at a certain price, you can lose big. The biggest mistake you can make in investing is taking too much risk, forcing you to get out of a position when it's going against you. So, for example, vol sellers who use that as a strategy, just sell premium all the time. As they make money on it, they get bigger and bigger and bigger, or some do. And they outsize the risk so that when it snaps against them, they're out of business and they have to cover it. The smart people always do it within the proper risk confines. So trading is probably more about risk than anything. Understanding risk, understanding how much risk to take, how much leverage to use versus the risk that you take. As I mentioned before, if I put on a riskless trade or a very low risk trade, I'll use more leverage. If I put on a very risky trade, I'll use less leverage. It goes back to what actually bottomed the stock market in March of 2009 was the fact that FASB abrogated 187, which is the mark-to-market rule. So if I'm a big bank and I've got all these bonds in my book. Okay, they're assets. They're used as collateral. So I hold all these treasury bonds. If those banks at the time had so much leverage, and they still do, okay, but let's say back in '08 they had 80-to-1 leverage, which means they had a very, very small amount of capital relative to their asset base. So if their assets are impaired in value, they're wiped out. And that's exactly what happened to the banks in '08. The bonds, if you remember, in '08, interest rates ticked up. So the bonds that they're holding might have gotten marked just down a little bit. I mean, maybe 98 to 94. But that little move in their bonds, then they had to mark in the market, would wipe out those banks. So basically, the market knew that all the banks were bankrupt. They threw everything at the market in '08, trying to get the stock market back up, TARP and all this liquidity. But with the banks bankrupt, the market kept going down. And the only thing that stopped it was, and it was a big surprise because nobody expected FASB to do something like this, but they basically said, oh, we're going to repeal 187, which was the mark-to-market rule. And I think to this day, it's still, there is no mark-to-market. So as soon as that happened, the market basically figured out that the banks were no longer bankrupt, and the market took off. What I'm trying to get at is when a bank buys a bond on leverage, especially 80-to-1 leverage, should they really not be marking them to market? If somebody buys a bond with cash and they want to hold it to maturity, okay, I can see that argument. But if a bank is buying a bond on 80-to-1 leverage and everybody knows they're not holding the bond to maturity, in fact, they're just using it as collateral, should they really not be marking them to market? So it's an example of how the system compensates for way too much risk and the blowups that occur and the things that they have to do to stabilize the situation.
It's a fascinating question just around the way in which different investors are subject to different mark-to-market profiles. I completely agree. Of course, one of the biggest being marked out of a position that we've ever seen was LTCM. Just vast exposures to mostly everything short vol, but specifically in our space, just a boatload of long-dated Vega that they, had effectively shorted through straddles on all these global indices. And for a period of time, the credit departments of big banks were so eager to do business with the entity that they could sell a straddle and post zero collateral. And it's an enabler of sizing that is, can be quite dangerous, of course. And I think that's really, to me, the lesson is around, as you say, sizing things appropriately and subject to the potential that the mark-to-market could be worse than you could imagine in some cases. I'm wondering, just as you sort of think about the 90s, so you were at Paine-Webber for a period of time, and then, of course, you and I worked together at Lehman Brothers. You ran an awfully large book at Lehman on the listed side, the index side. What stands out from that period of time just in terms of the customer interaction? And, you've always said that trading is a lot of trying to understand positioning and so forth. And I'm curious if you could share some of your thoughts on not just analyzing volatility, but analyzing the poker game that is trading. That seems to be a big part of what your orientation was.
Picking up on your long-term capital comment, that was the big thing that comes to my mind. As I was running trading, I was responsible for the risk that the book took in putting up customer trades. And most of those trades were pretty vanilla. People were buying puts and selling calls. Every once in a while, we would have somebody that was doing a name where you couldn't borrow stock. And those became, I remember it was Michael Stores that this one guy was betting that it was going to go out of business and you couldn't borrow the stock. So I demanded a very big price from him. And what I did was I traded a little basket of stocks against, and again, that was very, very risky. So I only did a certain amount so that I knew that even if the stock went to zero and my hedge didn't really work, it would be a de minimis loss for me. So that's one of the keys is you always have to be able to hedge a position, not only the delta, but also the convexity of the position. I used to talk to Jim Grant quite a bit. He used to call me up and ask me what's going on in the derivative market. And I said, look, all I can surmise is that long-term capital is doing these types of trades all over the street. And he said, hey, okay. He called me back about a week later. He said, would you give a speech about that at my symposium? And I said, okay. So I remember walking into this hotel, and there were 300 of the world's largest investors. And I got up there and I basically said, long-term capital is levering up the street. People really don't understand the risk that they're taking. I know that managements don't understand the risks. I don't think that there must not be traders like me who refuse to do the risks. So they must be loading up Wall Street on these types of trades. And if they ever go out of business, which there's a good chance because they're using at least 100-to-1 leverage when they do trades like this, which have huge amounts of risk. Now, I know that they were doing less risky trades, buying one bond, selling another bond, but putting up 100-to-1 leverage, trying to make a little bit of money and make a lot of money by making a little bit of a spread and using a lot of leverage. I basically laid out the case that long-term capital is a time bomb, and that managements don't necessarily understand the risks that their traders are probably taking. About 5 weeks later, Dick Fuld yanked me in his office, or they brought me upstairs and they fired me for giving that speech, basically saying I was off the reservation. I shouldn't have said things like that. And so I packed up and left Lehman Brothers. But the interesting thing is about, in the fall of 98, long-term capital blew up. And long-term capital blew up the street. And everybody lost a load of money. Now, what happened to me was somebody in the audience saved a lot of money because of what I said. And he was a billionaire. And he called me up. He said, I want you to be my CIO. I want you to travel around the world. I want you to interview hedge fund managers. And I want you to run our allocation committee. And I wound up working there for about 3 years, where I met several large investors. And one large investor wound up seeding my hedge fund that I started in 2001. And that's kind of how it all got started.
I just want to go back to LTCM and certainly remember you're leaving the firm and the hole it left in the growth of the equity derivative space. I focused on covering the firm more from a OTC and kind of structured product side, LTCM that is. The sheer size of the portfolio, especially once the blow up occurred and you saw the positions, as you noted, it wasn't just things like long short equity swaps and pairs trades and some short vol, gigantic interest rate swap trades and other types of really leveraged bets. So it was a gigantic portfolio. And I think this is what I wanted to get your take on, because you've traded so many options, you know the math inside and out, but in the trenches managing the risk and thinking about the real world, it to me felt like the professors at LTCM, as smart and as storied as their careers were in both academia and Meriwether's team from the Solly days, they really got stuck in the textbook and they forgot that the size of the portfolio and their interaction with the market itself could be part of the problem. They seemed to think that the risk model was all you needed and they just really forgot about sizing. And just curious, as you sort of think about, let's say the 90s and just running, some large books, what were the types of things that you considered in terms of sizing in derivatives? Was it sector concentrations? Was it kind of gamma limits that you were careful on? What were the broad kind of guidelines that you had for your own risk management process?
I figured out ways to always be long gamma, especially if you're running a derivative book on the sell side, because the main function of a derivative book on the sell side is to not lose money and to maybe make some money. And it's when people don't understand their objective and the long-term goal of things, I think that they make big mistakes. So we figured out and this goes back to Morgan Stanley days, how to really run a derivative book. We basically use what's called dispersion to do it. It kind of started at Morgan Stanley where we, initially were writing down positions on little pieces of paper because we didn't have computers yet. But when computers became prevalent in our business, we began to be able to monitor a lot of positions at the same time and treat them as one portfolio. So the basic premise is correlation. How are stocks intercorrelated to each other? How are stocks correlated to indexes? And then we can really assess what the risk was. But all those correlations can always break down. So the main tenet I learned is to figure out a way to hedge your tails. And that's by being in net long gamma. And what that means is if you're long an option and the market moves in a direction, you either get longer or shorter in the same direction. When you're short gamma, the opposite is true. So when you short an option, you have infinite risk if volatility goes up and direction really moves. And with gamma, you have isolated risk, or your risk is basically going your way because, again, you're actually making money when big moves occur. What dispersion is essentially selling indexed options, selling that premium neutral. So it's like selling a straddle in the index and buying a bunch of little straddles on stocks. And so if I go out and buy little straddles in the right weight on all the S&P 500 stocks and I sell one big straddle in the index, it's got very little risk to it. The way you make money on that is if certain stocks become very volatile, but the index doesn't. So you're earning kind of premium on the index, but you make money on, any individual stock that moves more than the implied volatility that you bought or the price of the option that you paid. So what that also does is you are essentially short correlation. Okay, so in other words, if stocks become more correlated when you have that position on, you will lose a little bit of money. If they become less correlated, as I mentioned before, you will make money. Okay, so for example, let's say I got two stocks and I have an index that's composed of two stocks. So if stock A goes up 1% and stock B goes up 1%, if they're equally weighted in the index will go up 1%. If they both go down 1%, then the index will go down 1%. But if A goes up 1% and B goes down 1%, the index will be unchanged. So notice the volatility of the two stocks didn't change, but I'm going to make money on that trade because I'm going to make money on A and I'm going to make money on B because they moved, and I'm going to make money on the index as well because it didn't move. So that's called being short correlation, okay? I made money because the correlation between those two stocks broke down or decreased. So short correlation actually acts like short volatility. So if I have that position, I can set up a portfolio where I can be both long gamma and short correlation. If volatility goes down, which is what all people that short volatility, short options try to make money on, I'll make money as well because volatility is correlated to correlation. In other words, I can set up a portfolio where I'm actually long volatility, long gamma, but short correlation. And I use that in my hedge fund. I actually use that offensively. I wouldn't go out and buy all volatility on all 500 stocks. What I would do is I had a methodology of picking certain stocks that had the potential of becoming more volatile than the implied volatilities, or when volatility picked up, became more volatile than the pickup in the index volatility. And it's very simple. One of the primary criteria is just leverage. If a company is levered, then if something little goes wrong, they miss earnings or whatever, you have a bigger move. It's called a tail move. So, for example, banks, we were huge long volatility early. I mean, it didn't matter in 05, 06, 07, 08. We were long volatility on banks because they were so levered. And as I mentioned, Just a little bit of a problem. Marking down bonds can send a very levered company bankrupt. And that's exactly what happened to the bank. So we made a lot of money by being short volatility in S&P 500. Even though we lost money on that particular part of the trade, we made so much more money on our stock volatility portfolio because banks almost went to zero. And I can remember in '06 buying implied volatility, buying options in banks at just ridiculously cheap prices, like 8, 9, 10, 11 implied volatility. And I can remember at the time as well.
I remember talking to you. I want to say it was early '08. I probably still have the email somewhere. You had a apocalyptic view on what was in motion. And boy, you were quite right, just in terms of specifically the financial system being able to absorb the body blow amidst all the leverage that they'd built up. Let's just rewind a little bit, because I want to talk about the founding of Vicis, the sort of philosophy behind which you established your hedge fund. Obviously, you were trading vol and converts and other complex products. When did you get started? And then let's talk about the period leading into the financial crisis, because if you're a long vol-oriented investor, those were some skinny times in terms of grinding it out amidst a very low vol period in the '04, '05, '06 timeframe. So tell us about the founding of Vicis.
I was at a fund of funds, acting as CIO, talking to hedge fund managers. I was also responsible for talking to investors at this firm. So they would come in and I would explain how portfolios put together on a fund of funds basis, different hedge funds. And I got to know a lot of these investors pretty well. In fact, one of my investors at Vicis I had met back then, and I'm actually probably going to go into business with him here in a month or so. But I met one investor there, and he came to me one day and he said, "You know what? I've been listening to you for a couple months now. I know your background. How about we start a hedge fund?" So we put together a business plan, explained to him exactly the nature of what I do and how I do it. He was actually a billionaire, one of those dot-com billionaires, very brilliant guy, developed an analytical tool for an optic switch. And he's kind of a scientist guy. So he seeded me with 180 million, and I put a team together of people, and that team lasted all through Vicis. We kind of put our heads down and started trading and generated a track record. By 2004, we had a good track record, and we began taking in outside money. Now, our investors, as I would explain the strategy, I never gave a target rate of return. I think that people that give target rates of return get themselves in trouble because you just don't know what the opportunity set is out there to make money. So I always talked about risk, and I talked about the profile of the returns. Now, the profile of the returns is basically, because I'm always long gamma, I can make more money when the volatility picks up than when it goes down. So when volatility goes down, I can make a tiny bit of money, a little bit of money. And when the volatility goes up, I can make a lot. And basically the vol is what I fed off of. So the more actually volatility went up and down, I can make money because I'm constantly buying vol back, selling it back out. What happened over a period of time is that our investor base began to come to me and invest with me because they knew I was going to make money when the market went down. And that when the market went up, I'm not going to, I might not make any money. There were periods of times where I didn't make money, but I wouldn't lose money either. So they began to look at me like a yielding put, where, if the market crashed, I would make some percentage of that crash. So if the market was down 30%, depending on how it happened, but if the market went down 30%, I could make 15%. So that's how I built my business, at least of what I did. Now, I had a partner that has another portfolio that was completely different that the seeder brought in. But what I did, I always stuck to my knitting and did it well. we were going along. Volatility became dirt cheap in 2006. I remember talking to a CEO of a trading company during our conversation. I said, yeah, I bought 6 vol in the index in the summer of '06. And I heard him getting on the computer, clicking on the computer, and he said, oh, you're full of shit. They never even traded there. And I'm like, all I can tell you is I was there. Okay. I said, were you there? He goes, no. And I go, well, I was there. Okay. And I bought a 3-month 105 call at a 6 in the S&P at a 6 vol. And he still didn't believe me. So it wasn't a very fun conversation, but what it also shows is that people that are in the market now must not have the experience that we built up over time. I mean, this was a CEO of a trading company, and he needed his computer, which is not going to show probably the intraday when things are moving around that, you're able to buy a 6 vol, number one, because, somebody came in and sold it to me below the bid, whatever. But volatility became so cheap in '06. Remember when Bernanke basically said the business cycle is solved. We've figured out the business cycle. We'll never have another recession again. Well, all that was really going on was that they were creating liquidity through debt. Okay, so liquidity can be created in only 2 ways, through income or debt creation. So if you have as your economy is going on and you're taking resources and converting them into income, that's generating liquidity, and that liquidity will find its way into asset prices. The other way, which has become pretty much 90% of the way liquidity is created these days, is by debt creation. So the Fed providing liquidity by expanding its balance sheet to banks through the fractional system, which doesn't really exist anymore, but that back then through the fractional banking system, keeping that going, lowering rates. A recession is a corrective process. A recession is saying, basically, we have too much debt. There's nobody to lend it to that has a productive project, and we want to slow the debt down so that capital is left over for when things are productive again. And instead, the Fed steps in when the market wants rates to actually go higher. It steps in and makes them lower. What that does is it offers debt to subpar investments, borrowing capacity from the future, so overbuilding essentially, and it creates a debt bubble. Now, those debt bubbles take lots of time, and sometimes there are corrective forces to offset the debt bubble, like a recession. But when Bernanke says something like we've solved the business cycle, something is wrong, because the business cycle is actually a corrective process to over excesses. And that's exactly what happened. He said that, I think, in '06. Now, what liquidity does is as this debt is getting created, more and more liquidity comes into the market and it dampens volatility. So volatility is kind of like the antithesis of liquidity. So volatility goes down as liquidity comes into the market. And when a crash happens, liquidity gets yanked out of the market, correlations go straight up, and markets go down, and volatility goes sky high because everybody's trying to get out at the same time. Because basically, with debt creation and low volatility, people take too much risk. So they buy way too many risky assets. They pile into the market, kind of like what they're doing in these days. So you never know when it's going to happen. You never know how it's going to happen. But that's why my strategy, I'll always stick to it, because it allows you essentially to be long gamma, and time isn't really a factor. But in '06, volatility was the cheapest I've ever seen it.
I wanted to just run with your 6 vol in '06 example, because there is one equivalent, and it was quite interesting. I remember doing a talk for some clients, and it was October 2017. So it was the 30th anniversary of the crash of '87. And my speech just so happened to line up with one of these incredibly depressed prices of options in the S&P. So I want to say it had a 6 handle. It was 1 month, so it wasn't super long dated or anything. And the straddle cost 1.5%. So over the course of the next month, all you needed was to move 1.5% away from spot. And I will tell you, as I'm sure you can remember, in some of your days of trading through low vol periods, you couldn't give this option away. It's a fascinating time. And I'm curious, when you think about the forces, in addition to the sort of leverage overhang that you're talking about, what might be the psychological forces? Someone sold that 105 strike call to you at 6.5 vol. What are the forces, maybe their behavioral or institutional considerations? What motivates someone to be on the other side of the trade in which you're scooping up very low option prices?
Agree, essentially. I mean, human nature drives, and human nature doesn't really change, I don't think. Human nature drives the market. I mean, PEs range from 10 to 40. And so a high PE is people taking a lot of risk owning a stock, and a low PE is taking less risk. That's it. People at certain times don't want risk, and people at other times want a lot of risk. And I'm no psychologist or anything, but I've read where the human mind does not assess risk properly. We tend to ignore risk when we have to, or most of the time. And when it's confronted with us, we will do anything to get out of that risk. So in an odd way, sometimes we take more risk than we should, and sometimes we take less risk. So it's just human nature. It's like when you're making money, you want to make more money. And so this is the typical vol seller. They've made money by selling vol, and they keep doing it. And they eventually outsize the risk for whatever reason. I'm a kind of a strange bird where I'm always conscious of the risk that I'm taking. For example, I could try, instead of making 0% when the market's going up or 5% when the market's going up, I could stretch it. I could use higher leverage. I tended to use, all my gross assets divided by my capital, I tended to use about 3 to 5 times leverage. When I used more leverage, I was longer gamma. So what I was doing really is I was just buying more options, and my portfolio was getting bigger relative to my capital because I was getting longer gamma. Now, I'm trying to do that within the context of risk again. And in 2006, what was really happening is I was buying options so cheap, my decay was so low, that all I had to do was make some money on a few stocks every month to compensate for it. So the odds were much better for me by increasing my leverage when I'm long gamma. So in 2006, made very little money, but in 2007, I came into 2007 long a lot of vol and a lot of Vega, but very, very cheaply. We had we had 3 volatility events in 2007, which was the precursor to 2008. So volatility began to pick up. February of 2007, we walked in one day and the stock market was down 300 points. No explanation. People like explanations, but sometimes there are none. People use the coronavirus as an excuse for the move that we saw, but it never would have been that big a move if the market wasn't as overvalued and volatility wasn't as cheap and there wasn't as much leverage in the market. Options are the most levered derivative. When you're short an option, you are using a huge amount of leverage. When you're long an option too, that's the definition of what an option is. And derivatives really is the tail that wags the dog. The derivative market is $1 quadrillion notionally. People have no idea how much debt is stuffed into the derivative market. People talk about the student loan market, $1.5 trillion debt. Okay, the derivative market is $1 quadrillion, right? So derivatives add leverage. They add debt. If I want to buy the S&P 500, I'm a pension fund manager. I can go pay $100 to buy it. I can buy it on margin at $50. or I can buy an S&P futures contract for $10 or less. So I'm buying, that's what leverage is. You're buying an asset for less money, and you're essentially borrowing the rest. So derivatives add a huge amount of leverage. That's where a lot of the debt is. The CFTC, I think, has done a real poor job in establishing margin requirements for derivatives. They should be much higher than they are, at least if you're not netting them out, not netting the risk out. So there's a huge amount of leverage in the derivative market.
So you were long vol in 2007. As you said, there were a couple of hiccups along the way. Of course, we had the quant crisis in August 2007. And it was very clear that something was amiss, that the signs from the credit markets were flashing more danger than a lofty S&P was reflecting. And the VIX was certainly up from 2006, but it wasn't, I think it got to as high as maybe 25 or so over the course of 2007. I'm curious, one, how you stay the course, because, there were times leading into the fall of 2008 where things got quiet again. The summer of 2008 was actually pretty quiet. I think the VIX in August of 2008 was down to 18 or so. So one, how do you stay the course and keep yourself not burning too much theta, keep convicted in your core view of being long volatility? That's one. And then I would love to hear you just express some of the things you saw during the financial crisis, asset prices you observed that kind of freaked you out a little bit, things that you were surprised by and some of the action that you saw. Obviously, you had it very right, but I'm just be great to just hear some of your thoughts on the crisis as well as it unfolded.
I basically, quote, unquote, stayed the course by trading the vol. When it got up high, I sold some. When it got back down low, I bought it back. And again, the more there's still vol, okay? I mean, even though to the casual observer, they just saw, lower vol. Vol was moving around all the time. It was moving around in skew. It was moving around on individual stocks. We would make bets on Vega, but we would always make those bets from the stock side. If we're going to buy vol, we're going to buy vol on a stock. We were almost 100% of the time short index vol. Yeah, and again, the only time I ever bought an index option was in the summer of 2006 when I just couldn't resist. I mean, it was 6 vol. It was ridiculous. By trading that vol, I mean, again, the more we could enter positions, exit positions, and we were one of the largest market makers upstairs in the world, we would get calls from the street all over the place, putting on fairly large trades. We took a lot of risk in actually putting positions on because, the probabilities versus the price you were getting an option at led you to a very high probability of being able to get your hedge off in the stock. By trading that up and down, up and down. So we were, even though vol was coming down, we were extremely active. One of the biggest, things that pop up in my mind was, and this is one way they were able to get vol down, which I realized was, again, artificial, was when they restricted short selling on different segments like the banks. You remember that?
I think it was August 2008.
Yeah. So we came in one day, I had heard it, I was up at night looking at things, and my guy from Hong Kong called me and said, we're hearing that they are going to restrict short selling in banks. Now, we were probably we held the largest short positions in the world in the banks, right? We were short stock, long call, pretty much neutral in all the banks, even in 2008. Now, a lot was moving around and we were kind of skewed out in some of these things, which means that we had sold down puts. And every time we sell a down put, right, if we sell volatility out in a name by selling a down put, I'll cover that Vega and Gamma in the index. So I'll buy it back in the index. So at certain times, we could be fairly de minimis in the index short when we're skewed out on stocks. I mean, our lawyers called us up and said, they haven't put a mandate. It's not like you're going to get arrested if you cover all these things. But, we had a meeting and we're like, okay, what should we do? And called up our prime broker. A lot of people had covered. The shorts were available. So we stayed short. We never covered. We actually kind of took advantage of the mispricing in the options market because of it, right? If you can't borrow stock, the put price is going to go up relative to the call price. Or if the borrow becomes difficult, again, the prices between the puts and the calls will change, right? If I'm being charged more to be short a stock, I'm not going to want to be long a call. I'm going to try to replace that with a put. So, that got very whacked out. So we actually went in and tried to borrow more because we were taking the other side of that trade. And we were putting on stuff, and as long as we could hold on to our short, we made money, and we were able to. I mean, eventually they just said, this is a really bad idea. We're not going to do it anymore. So, like most artificial attempts to create liquidity or to get the market up, as they say, doesn't really matter. The market's too big. They can't ultimately do it. The market's going to do what it's going to want to do. So that was an interesting time. And then we had the fall of '08, which was a big move. And the market kept going down and down and down. When you have an option portfolio, your gamma goes away. Like if I'm short a stock, long a call, struck at 110% of the stock price, and the stock goes down 50% or 30%, that call option is now worthless, depending on what volatility you mark it at. So if you market at a reasonable volatility, that call becomes worthless. Well, now you're still short stock. So I remember one day the market had made such a big move on the downside, we didn't even have a chance to buy everything we wanted to buy, because if you start buying too much, you can actually force the market back up again. So we were traders that always took our time covering deltas or covering stock. So I remember that night, I got on the phone and I called up the futures broker and I started buying futures. And the futures were, trading between 720 and 660. And I was buying a lot. Actually, at one point, the guy's boss had to get on the phone, like, make sure I'm John Succo and make sure I run Vicis. He said, okay, well, if you're not John Succo, I'm probably going to be out of a job. So I hope you're John Succo. And, well, it's just kind of a joke. But I bought so many futures between those levels. I think I bought like $1 billion of futures or something, because there was a seller, right? That's what normally happens. And it was actually kind of like a good way to do it, because if you're just buying from a seller who's trying to get out, you just put them out there, you get hit, you put them out there, you get hit, you keep doing it. And before the guy realizes that he's done, he's happy, but, I'm happy too.
Just in terms of re-hedging, we've got this generally simplistic view on the delta that spits out of Black-Scholes, but sometimes the delta can be influenced by other factors, and the financial crisis is one of those. So first, in Tesla, this gigantic, I don't know if you want to call it a short squeeze, but the ramp up was one in which the stock price and the vol accelerated together, and you actually had puts that ex post had a positive delta. The stock went up, and because the vol expanded so much, the puts actually went up in value. And I remember during the financial crisis, I had a client that was short one of the financials, and I said, why don't we buy some upside calls? It was actually Goldman Sachs. And the stock fell from 100 to 80 in minutes. And I looked at these 130 strike calls and they were up in value. The vol had blown up that much. It overwhelmed the delta move. How do you think about the hedge ratio in the context of vols that are expanding and moving around so much? Has that become a complicating issue for you?
Oh, well, no. I mean, that's the difference between art and science. The science of the Black-Scholes model would say, okay, the implied volatility is this, I got to hedge it here. That could be a disaster if you don't have any experience in how that actually operates. The opposite of that story is in the March of '09, when the market bottomed out, as I explained, and started going straight up. So at the time, volatility, implied volatilities were very high. We were long out of the money calls. If I had marked them at the existing implied volatility, let's say that a call would have a 30 delta. Now, I know that if the market goes up, volatility will go down. And so I just look at that call and I say, okay, let's mark, instead of marking at the implied volatility that it's at, let's mark it at a slightly higher vol than normal. Call it 16. Well, at 16, that call's worthless and it has no delta. An option is the higher the vol, the more an option's worth. As you explained, it doesn't matter. It's a put or a call, because an option, you can delta hedge it and create a neutral straddle, and all you wanted to do is move. Okay, so you would pay more for a put and more for a call. Interest rates have something to do with it too. I mean, if interest rates go up, I'll pay more for a call and less for a put. So there's all kinds of things that you have to understand when you trade a big option portfolio like that. We used to hedge out our row, so it didn't make that much difference on interest rates. But marking things to an implied volatility is essential within the context of what the market's doing. So when the markets start going up, do I really want to be short stock against a call that's 25% out of the money? Sometimes the answer is, well, maybe some, but certainly not what the delta is implying based on the current implied volatility. So we would have overrides where I could go in and override things. Now, if the market kept going down, I would have made more money if I had hedged that call the way implied volatilities had told me to, but I'd also be at a lot more risk as the market went up. So there's other things you can do too. You can lean longer in other things that you want to be long in versus other stocks, but then you become a long short book. So we didn't do a lot of that. We did some, but not a lot of it.
So as we look at the period in going into the financial crisis, and as you correctly identified, the margin for error for these banks that seem safe in terms of their implied volatilities, their CDS levels were record lows in 06 and even early 07. But the actual risk was something of a time bomb and just no room to be wrong. As you look at that period and then you look at the current day regime of pretty low vol, maybe not as low, but low, incredibly low interest rates, a lot of central bank policy, a lot of computerization in terms of trading strategies. You know, the liquidity provision in markets tends to be more about machines and algorithms these days. What are some of the things that you're worried about these days, the types of things that might not be properly priced? Maybe the central banks don't see things the right way. What's on your mind?
First of all, they're pumping the crap out of the market. Notice how the Fed came out and said, we're going to whittle down our balance sheet, which would tighten the market, right? If they went out and started selling some of the bonds they own, that certainly would. I mean, the pre-crisis of 08, the Fed's balance sheet was about $800 billion. It's still, to this day, it's somewhere between 4 and 5 trillion. Nobody really knows, I think, exactly what it is. That's one sign that things aren't normal, that the Fed can't seem to get their balance sheet down to any significant degree, because if they did, that would pull liquidity out of the market. One thing that was really interesting, I actually wrote in LinkedIn about, was the blow up in the repo market. That's an important event. And the Fed has stepped in and taken over, making sure that that market's operating properly. But essentially, what it does is it shows you that the bank debt in this country is way out of whack. It's way too high. So what happens is when a bank makes a loan or they borrow money, let's say they borrow money from the Fed, they have to post a bond as collateral. So there's a huge demand for treasuries. And in fact, there's actually a shortage of treasuries in the market. The banks are trying to borrow so many treasuries to post as collateral, the repo market got turned upside down. In other words, if I went in to purchase a bond, there wasn't really anything offered. And that even includes, another way to look at it is, there is a tremendous amount of rehypothecation. I'll give you an example. Let's say you got 3 different banks that have just borrowed from the Fed and they need to go get a bond. So they need to go borrow a bond to post as collateral to the Fed. Now, JP Morgan controls this market. So the first guy goes in, hey, JP Morgan, I need a bond for 9 months. Okay, here it is. The second guy goes in and they go, I need a bond for 6 months. Well, guess what? There are no bonds left. They've all been lent out. But what JP Morgan will do is go, okay, well, I don't need this bond for 9 months. So he takes the same exact bond and lends it to the second guy for 6 months. And then the third guy comes in and says, I need a bond for 3 months. So they take the bond that they've lent twice out, 9 months, 6 months, and they lend it to the guy for 3 months. So that's rehypothecation, but it shows you that there is a significant shortage of treasuries, which is kind of funny, given that there's probably $25 trillion of treasuries out there, some floatable, some not. It's kind of ironic that we have such a big debt, national debt, yet we have a shortage of treasuries. And that's because the bank debt is so astronomical. That's what I look at. I look at, and when we were looking at in 08, we were looking at the amount of debt in the market. So when you create debt, you create liquidity, it all goes up. But what you look for is some kind of end to the debt cycle where borrowers just can't borrow anymore, and lenders can probably, except for limits on the size of the Fed's balance sheet, because it seems like the Fed lends to everybody now, where they lend to the big banks lend to the smaller banks. That's what I meant by there's really no fractional reserve system anymore per se. There's an additional system out there where people just borrow from the Fed. So when that debt cycle slows down and rolls over, that's when the trouble begins, because you have to keep liquidity coming into the market just to keep the market from going down. There's always sellers of stocks, but are there always buyers? And one of the major buyers also, another area of concern, are corporations buying back their stock. If you look at McDonald's, this is just an example, but if you look at McDonald's balance sheet, they have a negative retained earnings, because when you buy back stock, it's a contra equity account. It's a contra equity entry. So every time you buy back stock, that stock goes on as an asset, but it comes out of retained earnings. So here you have McDonald's hamburgers with 5 years of sequential lower revenues. I mean, it may have stabilized. I don't know. I haven't looked at it lately. But you have declining revenues. You have extreme competition. You have lower margins. The company's doing everything they can, and yet they have negative retained earnings, and the stock's trading at like a high PE, between 25 and 30. Now, the bulls will tell you, oh, they got so much real estate. They're not marking it. It's so valuable. But that's part of their business. Okay, without that real estate, I guess they could sell it. But then whatever. But I'm just showing that the condition of their balance sheet is typical of all these corporations that have retired and bought back so much stock. And this is how they've kept their earnings per share growing, by buying back stock. They retire, stock outstanding. So per share, even though their actual notional amount of earnings might be going down, they can show increasing earnings per share. So those are just a couple examples that, hey, things not really behind the scenes all that great. I mean, it could go on for a while. But I just had an interesting call, as I mentioned beginning, from an old investor that's created a wealth management firm, a very smart guy. And he said, I'd like you to recreate your profile that you had at Vicis, and I want to use you as an asset allocation bucket, because there are no negatively correlated assets other than cash and zero correlated probably, and being short stocks. And you can't be short stocks. I've shorted more stocks in my lifetime, but I've always done it neutrally. Maybe there are some guys out there that are really good at shorting stocks. You have to pick the right stock. You have to pick the right amount of risk. And you have to create a synthetic call option, which means that as the stock goes up, you're actually going to cover it to control the risk. And as it goes back down, you reshort it. So you're creating a long synthetic call option against you're short stock, or in other words, you're creating a synthetic put. But, I mean, what do you do as a wealth manager? You know, if you allocate, let's say you allocate X percent to stocks and X percent to bonds. Well, guess what? In today's world, they're correlated. I can tell you right now, if interest rates go up, bonds are going to go down. And if interest rates go up, stocks are going to go down. Because everybody's long stocks because they're looking for yield, and that's it. So those two assets are correlated. So as a wealth manager, what do? If you can't short stocks, you look for an alternative like the profile that I'm talking about.
Yeah, it's a incredibly interesting time in the sense that you would think that low rates would not coexist with low stock prices because low rates might be something that suggests lower growth profiles, economic weakness. But I would agree it's the low rates that cause the high stock prices. And on your rates up, stocks down profile or that risk scenario, boy, that's the death knell for so many portfolios. It would be unfortunate. And I would also just share your view that folks are really forced into probably suboptimal decisions, and they're really not properly diversified. The last question I'll ask you is just on the topic of volatility. We know over time, if you did a long chart of the VIX versus realized volatility, there's a premium there. That's call it an insurance premium, but the implied's clear north of realized. As you sort of think forward in terms of the fragilities that we might see in the system and trying to use option prices as a diversifier, what's the balance there? Is it just trying to time it to try to use some of the, historical markers that have worked for you in identifying when that debt cycle is kind of coming to a close? Is that how you balance the timing of when to buy options?
Big corrections normally start from low volatility regimes. And that's because a option that, and that's a general statement, but options that are cheap, in other words, when implied volatilities are low, have more gamma. Okay, and gamma acts like leverage. In other words, the change in the delta. So if gamma is high and I'm short an option that's cheap, that delta is going to move very quickly. I'm going to be out-risked very quickly. Whereas expensive options have lower gamma. Look at it this way. If I'm short an option, at the money option at $1, I have a lot less cushion than if I'm short that same option at $2, right? So just as implied volatility goes up and Vega goes up, which is the amount of change in price versus the change in volatility, as that is higher, you have more cushion and it has less gamma to it. So if everybody's short options very cheaply, which means that, the only way to make money in this market is to go short options, short out of the money put. So everybody starts doing it. They drive implied volatilities down. So the level of implied volatility is lower than what it should be. Everybody's, all these people are short options that are de-risked. And all of a sudden, volatility starts picking up just because there are no more sellers, maybe. And it tries to return back to its natural rhythm of volatility. And that's, every stock has a rhythm of volatility. It has a certain balance sheet. And as I mentioned before, leverage tends to drive more tail risk than others. So if you have a company with a lot of leverage to it, eventually you have bigger tail moves. Ironically, you probably have less day-to-day volatility. But when I buy volatility on a stock, I'm not buying it for day-to-day volatility. I'm buying it because I'm normally short an index option against it. I'm buying it for tail moves. That's why we target what we do. So, there was a period of time where banks were had very low volatility. So we made zero. I mean, we were short index options against it, but, at a point, we make our bets on the Vega on stocks. So, as volatility is going down, we get to a point where we're willing to be kind of longer volatility on stocks, and we cover some of the index volatility against it. And then when volatility goes back up, we reshort the index. So again, we just trade that back and forth.
That's good stuff. John, I want to thank you for your time. We got some great material in here, and it was great to catch up. Thanks for being a guest.
Thanks, Dean. Nice talking to you.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchange.com.